If you have $500,000 in taxable investments like a money market CD, brokerage account, or even stocks or mutual funds, is that too much? The short answer in most cases is yes. But to understand why, we have to acknowledge that there are three basic types of investment accounts: taxable, tax-deferred, and tax-free. Taxable investments are those where every year as your money grows, you get to pay a tax. Common taxable investments are CDs, money markets, stocks, bonds, mutual funds, and brokerage accounts. With tax-deferred investments, you don't pay taxes as your money grows. You pay it at the end when you take the money out. Common tax-deferred investments include 401ks, IRAs, 403bs, 457s. You get the idea. With tax-free investments, you use after-tax dollars, but once contributed, you don't ever pay taxes on those dollars ever again. Common examples include Roth IRAs, Roth 401ks, Roth conversions, and some types of properly structured cash value life insurance policies, also known as a life insurance retirement plan or LIRP. So let's get back to the taxable bucket. If you get taxed on these dollars every time your money grows, why have these types of accounts at all? You need these types of accounts because they're liquid and they tend to be safe. For that reason, they make for great emergency funds. And financial experts generally agree that you should have about 6 months worth of basic living expenses in your emergency fund. But the question becomes, why is it a problem to have too much money in your taxable bucket? The big issue is that it's the least efficient of all investment accounts. Consider this: if you won the Powerball lottery, the federal government would be perfectly content if you deposited every last penny of those winnings into your taxable bucket. Why? Because it's the bucket where they make the most money. That's why there are no contribution limits or income limitations for the taxable bucket. Contrast that with the $7,500 limit for an IRA or Roth IRA. It's the least tax efficient of all the investment buckets, and so the federal government welcomes every contribution you're willing to make. The other problem with the taxable bucket is that most experts agree that tax rates, even 10 years from now, are likely to be dramatically higher than they are today. This exposes your investment to what I call the double compounding effect. As your bucket grows, your tax bill gets bigger, and as tax rates go up, your tax bill compounds even further. Consider this from my best-selling book, The Power of Zero. Let's say that you make a contribution of $100,000 to a taxable investment which earns 5% per year. Because this investment is taxable, you would pay tax at your marginal tax rate, both state and federal. In this example, we'll use 24% federal and 6% state, for a total of 30%. By the end of the first year, your pre-tax investment return is $5,000, but when we figure in taxes at the 30% rate, your true after-tax return is only $3,500. In this chart, we continue down this road for 10 years, raising taxes by 1% with each passing year. By the 10th year, you can see the true impact of this double compounding effect, a 74% increase in your tax bill. In short, it's okay to have too much money in your taxable investment or brokerage account, so long as you're willing to pay the additional tax to the IRS over the balance of your lifetime. In the truest sense, the taxes you pay on your taxable investments are optional taxes. There are so many other investment accounts where you pay no tax that it really is foolhardy to have more than 6 months worth of basic living expenses in this bucket. But if you're already to the point where the balances in your taxable investments far exceed the ideal amount, what options do you have to mitigate your taxes moving forward? Well, for starters, you should make sure that not a year goes by where you don't fully fund a Roth IRA for you and a Roth IRA for your spouse. If you're married, that's $15,000 per year. Roth IRAs are great because so long as you're 59 and a half when you take the money out, it's 100% tax-free. Furthermore, when you distribute money from your Roth, it doesn't count as provisional income. That means it doesn't count against the thresholds which cause Social Security taxation. Next, you'll want to fully fund another truly tax-free account, and that's you and your spouse's Roth 401k. That's an additional $60,000 per year. They'll have to take that money out of your paycheck, so you'll have to reimburse yourself out of the excessively large balance in your taxable investment. Once you've exhausted these tax-free alternatives, you may want to consider what I refer to in Chapter 5 of my best-selling book, The Power of Zero, as the Life Insurance Retirement Plan, or LIRP. This is an attractive tax-free accumulation tool because it has no income limitations and no contribution limits. I have clients that contribute $50 a month, and I have clients who contribute $200,000 per year and everywhere in between. An important facet of the LIRP is that it has a death benefit component that doubles as long-term care. In other words, if you can no longer perform 2 of 6 activities of daily living, and you can get one doctor to write one letter to that effect, you can receive your death benefit in advance of your death for the purpose of paying for long-term care. And if you die peacefully in your sleep 30 years from now, never having needed long-term care, guess what? Someone's still getting a death benefit, probably your kids or your grandkids. In summary, you must be very thoughtful and proactive about how you use the taxable bucket. It does serve as the ideal emergency fund, but you must always remember that it is the least tax efficient of the 3 buckets available to you. For that reason, you must limit your balance to 6 months worth of basic living expenses. And if your balance far exceeds this ideal amount, you can systematically reposition that money to tax-free by taking advantage of Roth IRAs, Roth 401ks, and a properly structured life insurance retirement plan. If you want to learn more about how to shield your hard-earned retirement savings from the impact of higher taxes, be sure to check out my tax-free toolkit. You can download it for free at taxfreetoolkit.com. If you're a financial professional and want to learn how to become a certified Power Zero advisor, head over to powerzero.com and opt into my free 3-part video series. By the way, if you have any comments or questions, feel free to drop them into the comments section below. I respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.